What is up, everybody? Welcome back to episode 21 of the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host, as always, Kyle Ryan, here with me today. And the topic of conversation this afternoon is all about how to de-risk your investments in your portfolio over time. I think this is something, Kyle, that you and I talk a lot about with our clients in particular, but also in a strategy perspective between you and I often, and how we can best navigate this conversation with the people that we serve. And, I think the key here is we've got a lot of kind of cookie cutter advice that we'll get into here throughout the episode that is out there kind of in the aura as far as how to do this properly. But it always kind of dwindles down to kind of this addled, saying, and the fact that everything needs to be personal for you, right? Somebody's de-risk strategy might be the complete opposite direction for yourself. And everybody has different risk tolerances and risk capacities. And that's something that, we're going to really dive into today. Kyle, I'd love to just kind of get your initial thoughts on the conversation.
Yeah, my big thing is, you don't want to reactively de-risk your portfolio. We just had a terrible year last year. You don't want to de-risk your portfolio because you had a bad year in stocks or bonds. You want to proactively do this. This is something that should go with your investment plan over time. As you age, you naturally de-risk your portfolio. The risk that we can take at 25 and 26 years old is a lot higher than someone ought to at age 70, age 50, age 60. It's something that goes over time. So I think the one thing I'd start out with saying is be proactive about your risk tolerance and your risk management. Don't be reactive.
Yeah. And I think the big question here, if you're listening to this episode and you're not a financial advisor and you're like, why should I de-risk? Because there's so much information and guru advice out there that says, oh, just buy an index fund and put your money in that, every month until you die. And there's some possible relevant information in there. But the issue there, as you said, is last year. What if you wanted to retire this year, right? And you had all of your money in an equity index fund and it's down, however much the index was down last year, right? Depending on which fund you choose, right? That's a huge hit. And the finance term for this is sequential rate of return risk. And to just totally bore that down, it's if you're approaching retirement and you have a big portfolio downturn and a decline, it's going to severely affect your ability to take out money in relation to the portfolio value that you had before the downturn. And so the importance of this conversation is you want to strategically de-risk your portfolio as you're getting close to retirement to try and preserve that lump sum that you've got so that you can retire in an efficient manner, right? I think that's the biggest conversation. And, for me, I tend to take a little bit of a different approach, I think, than most is I will actually be in a more conservative portfolio the few years coming up to and then the few years into retirement than I am actually 10 plus years into retirement. But having a conversation about how you're going to de-risk your portfolio to keep the value as you get to retirement, and then what you're going to do in order to sustain that over your retirement is a really important conversation.
That's an interesting thought. I haven't really thought about re-risking a portfolio as you get into it, but I think a good reason behind that would be once you retire, you don't really know what your monthly or annual expenses are going to be. You just retired. We've said this in past episodes. What's the best way to not spend money? Work. Can't spend money at work. So all of a sudden you have all this newfound time. You don't want to be risky because, as you mentioned, sequence of returns. You have to take money out of your account in a down year that's capturing a loss. It's harder to make that back up. So I haven't thought about that. It's really interesting. So as soon as you retire is probably the least risky time because you need to figure out what your actual cost of living is going to be, make those adjustments, live that reality, and see how you need to adjust your portfolio accordingly.
Yeah. And I'd love to get your take on that kind of guru cookie cutter rule of thumb that we were going to talk about here first is that rule of you want to have the amount of, what is it? The amount of fixed income is the number of years that you are old, however old you are. So, I'd love to just kind of get your take on that, because I think that's probably the one that from this specific conversation that we probably dispute the most.
Yeah, there's no doubt about it. I actually ran into a situation where, someone was just de-risking their portfolio over time. Each year they aged, they took 1% out of stocks and put it into bonds because that was the rule of thumb they knew. I'll start out by saying this. The greatest component of risk is time.
Yeah.
So the rule of thumb, right? If I'm 25 years old, it says I should have 25% of my allocation in bonds. I'm not going to do that.
Yeah.
That's why it's a rule of thumb, right? So it works for everyone. It works differently for everyone. I have a very high risk tolerance. I can watch my money go down for years and I wouldn't panic, right? Because everyone's different. But me, do I have zero bonds in my portfolio? No, I have some. I think it's really, it's an interesting environment for bonds right now.
Yeah.
But I personally, it's a rule of thumb. I don't abide by it, but like I said, it's a very good foundation to begin with.
Yeah, and I think also looking at it from a diversification perspective, like that ties into de-risking as well, because if you have, all of your monies in one specific fund that's in one specific asset class or category of investments, that's a high level of risk that you're taking on. And just essentially the idea of broadening the investment scope of your assets is really important. Having some in the US, having some in the international, having some in real estate, having some in fixed income, having some in other sources. Private equity is becoming, a great diversifier per se, and its correlation, how it moves in different, cadences and tones than the traditional stock market. Looking at
Absolutely.
those things and putting together, investments that maybe even have some barriers or some buffers, provide a lot of value if you can provide it. But I think it's just really taking the step back. And I think one of the things that I'm having a conversation a lot with older clients right now is how hard it is for them to take de-risking seriously when from 2010 to 2020, it was one of, the better 10-year runs in the stock market ever. Right now, they're in a space where we're at a bit of a stalemate with the market, where stocks aren't necessarily doing very well, bonds aren't necessarily doing very well. Now, bonds are starting to pay some good yield, but they're still, fairly volatile from a fixed income perspective. People are having a hard time understanding the importance of it. And
Yes.
I think that's why it's important to have this conversation.
Oh, there's no doubt about it. I mean, one of the most consistent conversations I've had since the start of 2022 has been based around really investor psychology,
Yeah.
right? Because I always like to say you don't own the highs, right? They just because a stock was at $500 a year ago doesn't mean it's not there anymore, right? Unless you sell it and capture that gain, it's not there. So I think it's really important to understand, like, just because, like you said, we've had this 10-year bull run where it was almost nothing but gains, a couple of hiccups here and there, but people expect that all of a
Yeah.
sudden. You
Yeah.
expect it. And once you start seeing a downturn in economic conditions, you forget that it's part of a regular economic cycle. It's actually very healthy for the market to pull back, because it's not like the market's just perfectly priced the whole way. It goes up and it goes overpriced and it goes below price. It's at a discount, it's at a premium. So
Yeah.
you got to understand where you're at, and the psychology of it is so important, because if you understand that this is ideally just a blip in the radar, we might come back. History shows that we can't base future performance on historical results, the whole 9 yards. But if history repeats itself, and we revert back to where we were, then you would have made out by not completely de-risking your portfolio and being reactive,
Yeah.
right? So that's why investor psychology and being almost a behavioral coach when it comes to investing is really important right now. A lot of
Yeah.
the value of a financial advisor is being that objective sounding board.
Hmm.
Right before we got on this call, I had a call come in saying, economic conditions are getting worse. Like, what should we do? No, we're not unless there's a fundamental reason to be selling and de-risking. We're not just going to do it from a headline. It's something that we do over time. We don't want to react. Again, it's all about being proactive.
Yeah. Absolutely. And I think that the de-risk conversation kind of plays into two different roles. And what I mean by that is there's risk tolerance, which is how much you can handle mentally, and emotionally, how much, volatility that you can handle in your own kind of persona. But there's risk capacity. And I differentiate that as risk capacity is how much volatility your financial plan can actually sustain. And I think that's a conversation that a lot of people don't have, especially if they don't have an advisor, is they don't necessarily know that risk capacity framework. And that's where I tend to base a lot of my strategy creation and a de-risk environment, kind of that I would almost call it like a glide path of your portfolio slowly de-risking. And also in retirement, like where you feel comfortable, because for some people, that's a certain number of years of expenses in cash. For some people, that's a certain number of years of expenses and considered more conservative investments like fixed income.
Yeah.
Is you want to try and dial that in to a place that makes you feel the most comfortable. And that's something from a cash perspective that I'm really starting to have conversations with people about, is pushing away monies while they're making income into a savings account that could maybe even cover up to the first full year of their retirement in cash. And then that puts a lot of ease on the portfolio because they're not having to necessarily worry about that first year's retirement expenses in cash. Because I think you're totally right. That first year, it's such an interesting first year in retirement. And I know you and I are so far away from it ourselves, but we just, we work with people who go through those environments, and it's just so up in the air. You don't know how much you're going to spend. You think you're going to spend how much you do as you're working, but that tends to vary for some people. And I think, looking at it from a portfolio perspective, you need to start having conversations about, hey, what's the right mix for me as I'm getting, close to retirement?
I couldn't agree more. And I want to nitpick a word you used.
Yeah.
Is feeling comfortable.
Yeah.
Sometimes, as much as people don't want to accept it, it's the best thing to do is be uncomfortable, right?
That's true.
Think about
Yeah.
the best buying opportunities in the market, right? It's when conditions were at their worst, consumer confidence was at its lowest, right? So sometimes the uncomfortable decision that you make can be the best one. Not always, no doubt about it. But sometimes making that uncomfortable decision is the difference between a serious rate of return, right? Like, because if you completely cashed out at the end of 2008 but you felt comfortable because you're in cash, you can't lose anymore, you missed out on the return, right? So I just wanted to nitpick that.
No,
Sometimes,
that's important. I appreciate you doing that.
yeah, of course. Sometimes it's important to be uncomfortable. Sometimes it's important to not be emotional and be objective. Look not just at today, but 10 years from now. It's like buying right now. It's like if you are sitting on cash right now and you want to buy into the market, I don't know if I want to buy in the market. We could be going to a recession and might get better buying opportunities on the horizon. Well, now you're dealing with timing risk. There's always going to be a risk, whether you buy now, 6 months, 12 months. But in 10 years, 20 years, you're going to really care if you bought in at the S&P at 3,900 or 3,700, right? So I think sometimes you just have to be a little uncomfortable, and that can be the best decision to make, as uncomfortable as it is. Because right now, cash assets, risk-free assets are yielding at 4 or 5%, depending on where you go. Like, each situation is different, right? Like right now, feeling comfortable getting a 5% rate of return on a risk-free asset, that's not bad. So like, but this doesn't apply to everything. It's just in general, sometimes you have to make that uncomfortable decision.
Yeah, and I think that's so important to have a conversation about, because I also think that you really need to start, and this is more like just psychological, not even necessarily concerning money a little bit, but the difference between hindsight and foresight, looking back versus looking forward. I think that us as people just in general are very good at making hindsight conversations or hindsight analysis. It's the foresight that puts you in a better situation going forward. And I think that our present emotions affect our foresight so much in today's day and age. And I think it's because there's just so much coming at us all the time. I even made a LinkedIn post the other day. And it didn't have to do with anybody else, but I've just gotten fed up right now with all of the news and all of the conversations surrounding the market. And, I talked about the idea of there's a huge difference between watching the news so that you can understand what's going on, watching the news daily so you can understand what's going on in the world, what's going on in the market, and making your investment decisions on that news, right? There's a huge difference there. And I kind of reverted back to, Warren Buffett's famous saying that whenever he makes an investment, he plans to hold it forever, right? And the conversation that a lot of people would say, oh, well, he can do that because he's incredibly wealthy. And my take is, I think because he does that, he's incredibly wealthy.
Yes.
And that's more of like a long-term investment conversation. But I think that this all ties into the idea of having a legitimate strategy into what you're doing. And I think that it really plays, especially in the long term.
Absolutely. Sometimes you have to make tactical adjustments because of the situation you're given, right? I always like to use another metaphor is like, you're a baseball guy. You'll like this one. It's like we're just the outfielders. All we want to do, we don't know where the ball's going. We're just trying to position ourselves based on what we know to be where the ball's going.
Yeah.
Wayne Gretzky, don't go where the puck is, go where you think the puck's going, right?
Yeah.
So that's the idea. And if you think that things are, again, it goes back to reactive versus proactive. Now, no one has foresight and knows what's going on. But if you can, reasonably start sniffing out, or you don't think you need to take as much risk as you currently are for any reason, then maybe it's a good time to de-risk. It's interesting because it gets emotional. There's no doubt it gets emotional because a lot of people react and then you want to de-risk when it's too late. And that's why, like you keep mentioning, having a strategy, having a strategy of de-risking over time. I wanted to comment on target date funds, right? If you have a 401k and you haven't selected your investments on your own, the chances are you're in what's referred to as a target date retirement fund. Now let's talk about de-risking over time. I already mentioned time is the greatest component of risk. So what happens as a 25-year-old if I invest in a target date fund? It's going to put me out to my age 65. It's going to give me the 2065 portfolio. And as I get closer to that year, I'm going to have less stocks, more bonds, going to become more and more conservative. So there's a reason that they're doing it. It's because as you get older, you probably ought to take less risk. Now, everyone's different. If you don't have to depend on your investments for your income, if it's going to get inherited, then yeah, understand your time horizon of your account. That's the most important thing.
Yeah. And, I kind of had a light bulb moment here. And I think that this is, at least personally, a really good way to think about this. But you should de-risk your investments according to your planning timeline, not the current market situation. I think if you can just think through that and get that through your head according to your planning horizon and the strategy that you have in place, not based off of the current market environment, right?
Absolutely.
Because it's completely out of our control. How the market reacts to anything is completely out of everyone's control. I think that's so important to think about and to consider and to understand, and just looking at the track record of the stock market, and understand that the long-term players win in most cases. That you just have to have that philosophy and that ideology when it comes to this long-term game of retirement planning, is kind of hitting home there.
I'm so glad you brought that up because I always tell people we need to beat the rate of return of your plan, not the market. If the market's averaging, I don't know, 12% each year since inception, somewhere around there, and we're running your plan at a 6% rate of return, you don't have to beat 12, you just have to beat 6. And if you can't beat 6 on an average basis, well, then we have to start making adjustments to the plan. Otherwise, you're just shooting in the dark, and no one wants to. Again, going back to the cliche, no one plans to fail. Some people just fail to plan, and understanding that piece is a very important part of the plan.
Yeah, absolutely. I think this has been great. Let's go ahead and wrap it up if you don't have anything else.
That was it for me.
If you're watching, listening, doing a little bit of both, and you have questions coming from this, and maybe you want to fine tune your strategy, or maybe you don't have a strategy at all, and you want to start developing it, feel free, reach out to Kyle or myself. We've got our contact info on our social media and on our YouTube sites. We'd love to talk with you. We appreciate you guys watching, and we're excited for next week's episode. Thanks so much, Kyle.
Yep.